Tired of feeling like you're on a never-ending treasure hunt in the stock market? Well, grab your binoculars and put them away. The search is over. Today, we're taking a deep dive into the world of long-term investments and revealing the top opportunities that will have you swimming in growth and stability. Whether you're a seasoned pro or just starting to dip your toes in the investing pool, this video will arm you with all the information you need to make smart investment decisions. Welcome to our channel that provides helpful videos on finance, investing, and earning more money in order to be independent and escape the financial system that has been binding us for ages. We do not provide financial advice, and anything that is said on this YouTube channel should not be seen as financial advice. These are biased opinions based on knowledge and personal experience. You should always remember that investing involves risk, and you should always conduct your own research before making any investments. Please like our videos and subscribe to our channel for more helpful content. Thank you. So let's begin. 1. Growth stocks. Growth stocks, my friend, are the sports cars of the stock market. They're flashy and fast and have the potential to bring in some serious returns. When it comes to growth stocks, think of tech companies or any other business that invests heavily in expanding their operations. These types of stocks aren't for the faint of heart. Growth stocks can be risky, so it's important to do your research before jumping in. Ideally, you should have a high risk tolerance or be willing to hold on to your investment for several years. The reason for this is that the price per share of growth stocks is frequently higher than the company's profits, which can create some uncertainty. But here's the thing. Even though growth stocks may come with a higher degree of risk, they've historically been some of the best performers in the market. Companies like Alphabet and Amazon started off as high-growth businesses, and look at them now. The potential for an enormous payoff is certainly there if you find the right one. If you're ready to add some growth stocks to your portfolio, it's as simple as finding an online broker that offers stock trading. So, are you ready to take the wheel and rev up your investment returns? 2. Stock funds. Next up, let's talk about stock funds. These are pools of money that are invested in a variety of stocks, each with its own unique characteristics or themes. For example, you could choose a fund that invests in American stocks or large-cap stocks. If you're not interested in the nitty-gritty of researching individual stocks, a stock fund could be a great option for you. With a stock fund, you'll benefit from a lower level of risk and require less effort compared to buying individual stocks. Plus, you'll be investing in a diversified group of companies, meaning that your returns should be more stable. Of course, it's important to note that stock funds can still fluctuate significantly, with some years seeing losses and others seeing gains. However, you'll have peace of mind knowing that you're investing in a broad range of companies and not putting all your eggs in one basket. Some popular stock funds include index funds, like the S&P 500 Index Fund or the NASDAQ 100 Index Fund. These funds give you exposure to a range of high-growth stocks, as well as many other companies. As a result, your portfolio will be more varied and secure. When you invest in a stock fund, you'll get the average return of all the companies in the fund. This means that, compared to investing in individual stocks, your returns will be less volatile. You can easily purchase these funds at any online broker that sells ETFs or mutual funds. 3. Bond funds. Third, let's talk about bond funds. Bond funds are just pools of money that are invested in bonds from different companies. This can be done through mutual funds or exchange-traded funds. The bonds can differ in terms of length, risk, and issuer. When a company or government issues a bond, they promise to pay interest to the bondholders on a regular basis and return the bond's principal when it matures. Bond funds are a great way to diversify your bond portfolio without having to research and buy each bond separately. Bonds can be pricey, with each bond costing around $1,000, but bond ETFs offer a more affordable option, as they can often be purchased for less than $100. While bonds are subject to market fluctuations, bond funds tend to be more stable and only move in response to changes in interest rates. It's important to note that not all issuers are equal when it comes to risk. Some corporate issuers can be quite risky, while government issuers are typically considered to be relatively safe. Holding bonds in a fund makes them much safer and less likely to be affected by the default of a single bond. Bond funds generally offer a lower yield compared to stock funds, ranging from 4% to 5% per year, or even lower for government bonds. But they are also much safer. You have a wide range of options to choose from when it comes to bond funds, and you can easily purchase them from any online broker that sells ETFs or mutual funds. 4. Stocks that pay dividends. Stocks that pay dividends are like the trusty sit-ins of the investment world. While growth stocks might speed past you like sports cars, dividend stocks offer a steady and reliable journey. These stocks, which are often sold by well-known companies with a long history of success, pay dividends regularly. For those looking for a stable source of income, especially retirees, these stocks can be a great choice. Real estate investment trusts, for example, are a common type of dividend stock. They offer a steady stream of income, with the potential for the dividends to grow over time. But don't be fooled into thinking that just because these stocks offer dividends, they are immune to market fluctuations. While they tend to be more stable than growth stocks, they can still experience ups and downs during tough economic times. But conventional wisdom says that companies that pay dividends are safer investments, so they are a good choice for people who want to put their money somewhere more secure. And here's the cherry on top. The best dividend stocks often offer annual payouts of 3 to 4%, and sometimes even more, with the potential for 8 to 10% annual increases. It's like having a yearly raise in your salary. If you'd rather have a diverse portfolio of these income-generating stocks, there are plenty of dividend stock funds available. Simply find a reputable online broker that offers stock trading, and you'll be on your way to a steady and exciting investment journey. 5. Real estate. Real estate investment is a classic example of a long-term investment strategy. It requires a big financial investment and can come with big commissions. Most of the time, gains aren't seen right away, but over the course of a few years. But one good thing about investing in real estate is that a big part of the initial investment can be paid for by borrowing money from a bank and paying it back over time. This can make real estate investing a lucrative option. Real estate ownership can be particularly attractive to those who want to be their own boss and take advantage of tax regulations that favor property owners. However, it's important to note that being a landlord can be a hands-on job that requires a significant amount of time and effort. One danger of investing in real estate is taking on a large debt load, which increases your risk in the venture. Also, putting a lot of your money into a single property can be risky because it doesn't give you a lot of options. Operating expenses, such as mortgage payments, must still be made even if the building doesn't have a tenant. Even with these risks, there is a good chance of making money, and long-term investors can get a lot back on their initial investment if they choose the right properties and manage them well. Real estate is also a good investment for retirees because once the mortgage is paid off, it gives them security and an income. If you're interested in investing in rental property, consider seeking out a licensed real estate agent who can guide you through the process. 6. Robo-advisor portfolio. A robo-portfolio is a great option for those who want to invest but don't have the time to do it themselves. Simply fill out a few questions to help the robo-advisor understand your financial goals, risk tolerance, and time horizon. The robo-advisor will then build a personalized portfolio using low-cost ETFs and manage it for you. The cost of the robo-portfolio includes the cost of the funds and a small management fee, usually around 0.25% per year. Funds in robo-portfolios typically cost between $6 and $15 per $10,000 invested. Your robo-portfolio can be tailored to be as risky or safe as you like, with options to invest mostly in cash or even a savings account if that's what you prefer. But the returns you could get from a robo-portfolio depend a lot on how risky your investments are. A more balanced and diversified portfolio will have a more stable annual return, but the total return may be lower. Robo-portfolios are convenient and accessible, with several leading robo-advisors available to choose from. Whether you're looking for a long-term investment or a more hands-off approach, a robo-portfolio may be a good fit for you. Thanks for watching. Stay curious for the next video.